This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
If you are listening to this on the UK syllabus, it's because you've decided to sit the UK exam. You have to sit the UK exam if, for example, you are in audit and you can see that you will one day be made audit partner and therefore have to sign audit reports. If that's not the case, then you don't need to sit the UK exam. The UK exam means that you have to learn 2 sets of rules. So it is not recommended unless you can see that you are on the audit partner route. So even if you're in audit, it depends on your firm, doesn't it? But sometimes if 30 people enter the firm, maybe 2 will make partner. So you have to be realistic. So do not do the exam unless you are on the audit partner route. On the assumption that you are sitting for that reason, one of the questions will ask you about how things are different in the UK. Probably because you're already on the audit partner route, you know what those differences are. In which case, you might not need to do much more work here. However, if that's not the case, the notes here in our study notes summarize many of the key differences that apply. And I'm going to shorten those and just summarize some of the key points for you in this session. One of the things that you've studied already is the accounting standard on small and medium-sized entities under international standards. To be honest, that is very similar to the UK standard. So if you're ever in a pickle and you're not quite sure what the UK standard says, if you apply the rules in the small and medium-sized entity standard, you'll probably get the question right. The obvious danger of doing this is that you get the UK and international rules mixed up, which is why we always tell people, if possible, to try and do the international exam. So what I'm going to do, rather than just read through the note line by line, is just to highlight some of the key UK points. So I'm just going to call these UK highlights, some of the key differences, the ones that are really very easy for him to test, and in no particular order. So let's pick borrowing costs. You know, under international standards, they must be capitalized on qualifying assets. Well, in terms of UK, the capitalization is optional. So capitalization of borrowing costs on qualifying assets is optional. Secondly, development costs. You know that under international standards, they must be capitalized. Under UK standards, capitalization is optional. So those two go together. Some of the most significant differences concern goodwill. First of all, under international standards, there are 2 ways of calculating goodwill, full and partial. UK standards, then only partial goodwill, or proportionate goodwill, if you prefer to call it that. Secondly, international standards, goodwill is not amortized. UK standards, it is. So goodwill is amortized. Thirdly, under international standards, goodwill is credited to the P&L if it's negative, so negative goodwill or bargain purchase is credited to the profit and loss. Under UK standards, negative goodwill is recognised on the balance sheet and it's amortised. It's very strange. Positive goodwill is amortised over 10 years and negative goodwill amortised in the other direction over 10 years, and they show the two numbers together on the balance sheet. Fourthly, under international standards, goodwill, under international standards, contingent consideration is recognised at fair value. Under UK standards, contingent consideration is only recognised if it is probable. The next one out of the hat is leases. International standards, the lessee capitalises all leases unless they're less than a year or very small in value. Under UK standards, the lessee only capitalises leases that meet the definition of finance lease. So the lease accounting is different. So we would only capitalise finance leases in the books of the lessee. International standards, the lessee doesn't even think about finance or operating leases. They only worry about that, don't they, for the lessor. But UK standards, you have to do something like you do in the lessor, assess whether things are finance leases, and if they are, capitalise them. Otherwise, they'll be expensed. Again, are you going to see big numbers on this? No, but you do need an awareness of the difference. Next, financial instruments. This is slightly better news. It's much simpler. So there are only two ways of measuring. Either fair value with gains or losses going to the P&L, or amortised cost. So there's no fair value through OCI under UK standards. Next, IFRS 5 says isolate discontinued and assets held for sale. So assets held for sale there is no designation under UK standards. So assets held for sale you don't do anything different. You continue to depreciate. And you do not move them to current assets. The final one, and then I'll recap these, is deferred tax. International standards refer to recognition of deferred tax on temporary differences. UK standards, deferred tax is recognised on timing differences. It's a different word, isn't it? Most of the time it doesn't really affect the outcome I think one impact is something like a revaluation where under international standards you would recognise deferred tax. Under UK you would not, but I wouldn't expect to see any big numbers. That's not a complete list, but it's some of the key ones that we would probably see. Let's just look up and down it again. You've turned up at the UK exam. Hopefully you know you're in the UK exam, though sometimes candidates find it's a complete surprise they've entered the exam. Borrowing costs and development costs, you don't have to capitalise them. Goodwill, there's only one method, partial goodwill. It's amortised. Negative goodwill is treated consistently with positive goodwill by being shown on the SOFB. Contingent consideration is only measured if the outcome is probable. Leases, far fewer leases are capitalised under UK accounting, only those that meet the definition of finance lease. There are only 2 designations for financial instruments, and you can probably see that equities and derivatives would be measured at fair value, gains and losses in P&L, no designation of fair value through OCI, debt assets usually at amortised cost. Although you do get discontinuances, you don't get assets held for sale. Assets held for sale, so those non-current assets, leave them in non-current assets, don't move them, continue to depreciate them until they are sold. And finally, deferred tax. The reference there is on timing differences. Timing differences, again, where the tax is payable at a different time, of course, to the underlying profit being recorded. So it's a fairly similar concept to temporary differences. As I said at the start, enter the UK exam if you know if your employer requires it, or you can see yourself on the UK audit partner route. Otherwise, I'd recommend that you don't. Because why make trouble? You're having to learn 2 lots of rules and not 1. One of my students I know on our question bank said it sounds like a no-brainer, and that's probably the answer unless you're forced to. So there we are, some highlights from the UK. If you're doing the UK exam, then you need to go carefully now through the notes where it says UK versus IFRS differences at the back of our course notes. But I've introduced enough of the key points for you to get a good flavour. Thank you.